Happy Friday, everyone. Welcome to a special edition of Tech Check. And what a week it was for tech. We're ending on a down note. The Nasdaq closing lower by 1% today, but the rest of the week, it was a one big rip higher, outperforming the Dow and the S&P 500, as it has been all year. Big tech, the XLK, smaller, more speculative stocks, software, semis, e-com, they all ended the week higher. And we're headed right into the next big catalyst. Next week, we will get earnings from Netflix and Tesla. Tech companies will start to reveal what the second quarter was like for business, what the outlook is for the rest of the year. We've got software budgets, consumer spending, and of course, AI. How much it actually contributed to the bottom line. Perhaps less hype, more dollars, we shall see. Right now, we are digging into Cathie Wood's flagship ARK Innovation ETF, also rebounding this year. AI mania, falling inflation, easing recession fears. That is all powering speculative tech. The ETF hit an 11-month high today. Take a look at that chart. Outperforming even mega caps like Microsoft, Alphabet, and Apple, fueled by top two holdings, Tesla and Coinbase, which have doubled this year or more. Most of ARK's other disruptive tech funds with a similar or even better performance. There's ARK W, that targets next generation internet. There's also ARK F, focusing on fintech and blockchain. Both of those rallying more than 60% this year. But, and this is a big one, that marquee ARK fund still hasn't come close to the highs of the pandemic. It was, of course, the poster child of the tech boom during that period, but it has cratered over the last couple of years. It was one of the worst performing equity funds of 22, dragged down by losses in Roku, Zoom, Shopify. Just a few days ago, Wood also sold nearly $12 million worth of Coinbase, right as shares of the crypto exchange reached a yearly high. And of course, missed out on that jaw-dropping rally in Nvidia, which she exited entirely in early January in that flagship fund. Let's get an inside look. Joining us now is Cathie Wood herself, CEO of ARK Invest. Cathie, thanks so much for being with us. Let's start with Nvidia. Walk us through that decision, that process, why you judged that name to be overvalued right as it was taking off.
Yeah, so we started our research on artificial intelligence, actually when we were studying the possibility of autonomous vehicles way back in 2014. Nvidia at the time was $5. That's on the split basis, $5. Now it's closing in on $450. So we rode it all the way up until mid 300s, mid to high 300s in the flagship. Sold it because we saw the inventory problem brewing. That was a good call. Got back in the fourth quarter when it cratered. And then it just took off after ChatGPT, while all of our other stocks, many of them AI driven, I would say most of them actually, were still very, very weak. Mm-hmm. And just to give you an example, Nvidia was at 25 times revenues, while Twilio, which we think is going to be a huge beneficiary of AI, was at 2 times revenues. So we were making a valuation judgment call. We had done very well, 5 to 350 to 400. And we also kept it in our more narrowly focused portfolios, but took profits there as well.
Taking profits, sure. What makes Twilio sort of a better player to have in your portfolio or your ETF right now than an Nvidia?
Well, I think a lot of people understand that Nvidia is just an incredible play on AI, and it is priced accordingly. I don't think many people know that Twilio, if you use Uber, then the communication around Uber is powered by Twilio. So Twilio has roughly 1 trillion consumer business interactions per year. Now, who are going to be the winners in AI? It is going to be companies with visionary managements, good distribution, global in this case, and proprietary data. Twilio has data on business to consumer communications that no one else has. And we think the secret sauce and the real beneficiaries of AI are going to be those with proprietary data. The biggest one being Tesla. More data on real world driving miles than all the other auto companies and tech companies focused on autonomous in the world.
Right. When you compare a Tesla or a Twilio, though, Tesla is at a different scale. It's collecting much, much more data. As you said, what makes Twilio so disruptive? As you said, yes, it's acting as sort of intermediary for Uber drivers, let's say, and their customers, a number of other companies. But what makes it an artificial intelligence winner specifically? What is so disruptive?
So it is able to take the data, let's use Twilio's data on Uber. And if you'll notice, Uber has introduced many, many new services and advertising. And with this data, it is able to target consumers, basically sending them data, advertising, offers to buy at this restaurant or get a delivery from that restaurant, probably in a much more targeted way than most companies that are in between the consumer and businesses.
I'm still, I want to go back to Nvidia, though, right? I see the proposition there, maybe, and perhaps investors do more clearly as well, judging by how much it has bid up. Were you surprised by the monster quarter that Nvidia put out in May, when it wasn't just talking about artificial intelligence as something in the future, as kind of we are with some of these other names, but it's actually going to book revenue this year related to this huge platform shift. So what makes you think sort of an Nvidia at the time was overvalued when you have Zoom video, for example, a call that it could reach $500 billion?
So if you look at Nvidia, it is one of the Magnificent Seven. It is an easy way to put money to work. And the excitement around ChatGPT was such that this was the obvious play. It has been the check the box AI company for a while now, and rightly so. It has done an amazing job. However, whenever I hear the word shortage around anything, and you're hearing shortages around GPUs for AI computing power, I step back and say, okay, there's probably double ordering. This was true of everything during COVID, and it was a great call, an inventory call during COVID. I think we're going to see the same thing here.
But isn't its shortage of, the AI chips that everyone wants, isn't that part of the bull case for Nvidia? They can't produce enough because they're in such high demand?
Yes, and what happens when you hear the word shortage? What do you do as a purchasing manager? You have to you're the purchasing manager. You better have the supply. And when you don't get it, you double order, you triple order, you quadruple order. That happens routinely. And I'm not saying this is a cyclical comment. This is nothing about Nvidia's secular potential. We think it will face more competition than many people expect. We know AMD. We know companies like Tesla. Tesla has designed its own AI chip. Meta Platforms, own AI chip. So Google, same, own AI chip. So it doesn't have the market to itself like I think people think. And it's priced as though it is the one beneficiary out there. If you look at all of the stocks in our portfolio, the companies have proprietary data that no one else has.
So, Cathie, is this as good as it gets for Nvidia, or are you looking for an opportunity to pick back up some shares?
Sure. If it were to correct, it goes through these massive corrections around inventory gluts and shortages. And yes, we certainly would. But understand, it is a well understood play on AI at 25 times revenue. Tesla, now probably at 7 times revenue, is probably the biggest play out there in terms of the revenue potential. It's going after the autonomous taxi platform market, which we think is going to be an $8 to $10 trillion market globally by 2030. So we're looking again for those data plays and those with proprietary data. Nvidia is focused on hardware. For every dollar of hardware, AI will pull through probably $8 of software. So again, Nvidia, really important cornerstone stock, has from $5 to $450 done a lot of work. And now people understand it's out in the open. It's not the hidden gem that it was when we were looking at it as a PC gaming chip company, and nothing. That's how people looked at it, 7-8 years ago.
And then as a crypto play and now an AI play.
Exactly.
It's been through a number of cycles, yeah. And Cathie, as you said, you were in early. If you are looking at companies that have proprietary data, and certainly you're not the only person who says so, right? A lot of folks tell me here in Silicon Valley that it's the gold in this platform shift, the data that is. Why wouldn't you look to the big tech companies? Who's got more data than Microsoft, Amazon, Google?
Well, I think that they certainly have a lot of data, but I think that there are some disruptive forces at work. Take ChatGPT. I mean, that could harm Google mortally. It's either the worst thing that's happened to Google or could be the best if it's lighting a fire. But its advertising model is potentially at risk as ChatGPT disintermediates search. Amazon. ChatGPT could cause disintermediation in e-commerce. Just taking if you ask for a type of shoe, you say, I want it at the lowest cost, lowest shipping costs, directly within the next day. There's, your services evolving with ChatGPT like that can disintermediate Amazon and just take you to that site and order directly. So there's a little bit more disruption, I think, in the Magnificent Seven than many people understand.
Right, and Google's searching and building out its answer to that. But ChatGPT, Cathie, has this partnership with Microsoft. Microsoft is just another mega cap that's getting all the benefit, and ChatGPT essentially needed the compute power. So again, it sort of all paths currently lead back to big tech, or is that the wrong way of thinking about it?
Well, I just gave you two disruptions that we think.
But ChatGPT is part of Microsoft, right? Essentially.
But what are the risks with Microsoft? Again, price to perfection, right? Everybody knows this is a play. What could go wrong? Well, there are political forces at work that are focused on data privacy. And in Europe, GDPR, the privacy standards there, are much tougher. And anyone doing business from the US into Europe is going to have to abide by them. And they are starting to zoom in on AI and privacy. And that could throw a wrench into some of these big mega cap plays because they're the targets.
Right. Although we haven't seen investors react to that yet. Cathie, I want to switch gears a little bit. Let's talk about ARK more broadly. Investors stuck with you during losses in 2021 and 2022. This year, however, you're seeing outflows even as you're rebounding. What does that signal to you? So
our asset retention has been spectacular. I think everyone would agree with that. Asset retention through 21 and 22. We're up more than 50%, some of our funds 60% plus. So there would be natural profit taking, but there's something else that has happened over the last year. Our stock developed what traders would call a very nice base, a trading range. And I think we began to see opportunistic trading in the mid-30s to the mid-40s, and it seemed to top out regularly in the mid-40s. Well, we've just broken through that. And so recently, this week, our flows picked up very nicely because there are traders out there who are looking at ARK stock and says, wow, if it breaks out of this nice long base, it could have a very powerful move here. And as you can see from the chart, we are still down. If you compare ARKK to the NASDAQ 100, you'll see the NASDAQ's, getting close to its all-time highs, and ARKK, which is full of innovation, is much closer to its lows. So I do think we're beginning to see investors shift from the NASDAQ 100 or NASDAQ, take maybe losses or gains there and into our innovation fund, because I think the values when it comes to innovation are in our fund.
Where is that value, Cathie? Let's maybe look at that chart on a longer term basis. Let's say since ARK's inception in 2014, and I know you invest in disruptive business models, so you take a longer term view, but over that time, ARK has underperformed not just the NASDAQ, but the S&P 500. How should investors view your proposition, your value proposition to them?
Well, I think they should put into context what has happened in the last 2 years. Interest rates, the Fed jacked interest rates up 21-fold. Any long duration asset, and in the world of equities, innovation is going to be the longest duration. All long duration assets were slaughtered last year. The bond market, now that's long duration as well, but it's usually a flight to safety vehicle. The bond market last year had its worst year since sometime in the 1700s. If that was going to happen to bonds, which are usually flight to safety, just because they were long duration, that was going to happen to ARK in spades, and it did. Now, where are we? The market is starting to look to the other side of the interest rate increase, and they're starting to look at inflation, which is crumbling. Inflation is crumbling. I know that a lot of people use the word sticky, but you look at the leading indicators of inflation, they are coming down rapidly. And we do believe we're going to see deflation, which we're already seeing it in many places, but even in the broader based indices, and the Fed will have to adjust, and we'll be on the other side of the horror show we just went through.
Cathie, you've been talking about deflation for a long time, though. And some would argue many, though, missed, including the Fed itself, the rise in inflation and how sticky it has been. So what makes you think now is any different? Why should investors believe you this time when sort of you, but many others as well, have been wrong about it?
I don't think we've been wrong about it. When we were in COVID, we were talking about inventory shortages that would cause supply chain problems and the inflation that would come from that. Sure, we didn't know about Russia's invasion of Ukraine, but I think when history is the judge, and it will be, that history will judge the inflation we went through as the result of a massive supply shock to the system. Mm-hmm. And they will look at the comparison, not to the 70s, which I know Larry Summers and Mohammed El-Arian and others have used that analogy. We use the 19 teens. We went through a pandemic back then, the Spanish flu. We went through a war, World War I. We were on the gold standard, so money supply had to fall as inflation went up. Inflation went to 24%, June of 1920, dropped to minus 15 in June of 1921, and we moved into the roaring 20s. Why? Massive innovation, telephone, electricity, automobile. This period is much more like that period than like the 70s. And again, when history is the judge, it will look at the inflation chart, which went like this and is going like this now. And it will seem like it happened in a flash, even though going through it feels like we're in slow motion.
Okay, we'll see. Cathie, one last quick question. I was on Threads, as many people these days are, and I was looking up quickly. You have an account, so does ARK Invest, but you haven't threaded anything yet, if that's the right terminology. Do you plan to use it? And what do you think its proposition is over Twitter, if any?
So I won't be using it, but our marketing team, I'm sure, will be using it. And
why not you?
I think because the more productive social network for us at ARK is Twitter. I mean, the knowledge workers, the innovators we want to talk to are on Twitter, and we've established relationships with them. And so I can't imagine switching from Twitter. That doesn't mean Threads will be a failure. It's just going to be something different. It's not going to be what Twitter is, certainly not to us.
Cathie, I'm going to sneak one quick one last in. Any regrets over the last few years, the trade that you missed or made that you regret, perhaps?
Well, you know, I think, and many people will say, oh, you must have regretted missing Nvidia as you did, Deirdre, up front. Actually not. You know what we moved into? More Tesla, more Coinbase. Those are up as much as Nvidia. So I'm a portfolio manager. We're managing a portfolio. And when we see one valuation skyrocket and other valuations that should be responding to the same thing, artificial intelligence, getting crushed, we know what to do with that. So I don't regret it. What I What I wish that the media had focused on is how loud we were about Nvidia starting nearly 10 years ago in 2014. We said Nvidia, Nvidia, every time we came on your show, Nvidia. When it moved into...
That's fair. You wrote it all the way up.
Yes.
Fair point. And a good place to end on. Cathie Woods, as always, great to have you on. Thank you, and we'll talk to you soon. Have a good weekend.
You too.
Coming up, Hollywood on strike. Actors joining the writers on the picket line. A complete shutdown of film and TV productions underway. No resolution in sight. Shares of Warner Brothers, Discovery, Disney, and Netflix, they're all in the red today. We will break down the impact. We're just getting started on the CNBC special, Taking Stock.